Welcome to the Real Estate Espresso podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today's another AMA episode, that is, Ask Me Anything. I love to answer your questions, and if you have a question you think is going to be of broad interest, send it in. I'll answer it live on the air. Send your questions to victor@victorjm.com. That's victor@victorjm.com. Alan writes, thank you for all the valuable insight into real estate investing through the podcast. I was curious your thoughts about investing in apartment buildings right now. Do you think it's a strategic time to buy since there seems to be low demand for living in an apartment, with the recent pandemic subsequently lowering an apartment building's value and therefore getting a better deal? It's so difficult finding single-family properties that you can justify buying as an investor because they're so expensive right now. Since single-family properties have a high comparative market analysis driving up value, to large multifamily properties having a lower income value right now. I'm assuming that people will slowly begin to return to apartments, and with credit being so cheap, possibly having little demand for apartments, it might be a formula for a good investment. What are your thoughts? Thanks. Well, Alan, this is a great question. I'm going to reframe the question somewhat to make a couple of distinctions. As worded, your question's a little bit too general. You're asking a couple of different things here. Part of your question is focused on choosing between investing in apartments versus single-family homes for rentals. I don't view that trade-off as a yield-related trade-off. They're fundamentally different products, and I believe that whenever you invest, you've got to look at the supply-demand for that specific product in that specific location. Real estate is hyper-local. It's true that occupancy has fallen in high-rise apartments in New York, San Francisco, Seattle, and Toronto. These are temporary situations in some cases and point to problems in others. Determining whether the investment conditions are favorable depends on looking at three main factors. Number one, you've got to look at the local submarket conditions. Number two, the local boots on the ground team you've got performing your project management and property management. That's key. So you got to find the right team. And then number three, you got to look at the specifics of a particular deal. Your question's a little bit of an oversimplification of the issues which need to be looked at in a more holistic manner. If you pick a particular submarket, like Northwest Austin or downtown Nashville, which are undergoing significant growth, then you've got one set of market dynamics at play. Demand has exceeded supply by a wide margin, and home affordability is an issue. It's creating increased demand for rental product. Eventually, supply might catch up to meet the demand and possibly could surpass demand. A deep analysis of the local submarkets is essential to determine the supply-demand situation and to forecast what's possible in the 5 to 10 year time horizon in terms of both supply and demand. If you pick a submarket, like let's say the Upper West Side of Manhattan, there will be a different set of dynamics at play. It's different from Brooklyn or Queens or Hoboken, New Jersey. There's no question that there's a lot of institutional money chasing too few opportunities, which is creating demand for well-managed, stabilized product. Investors in search of yield have been bidding up prices for these stabilized apartment complexes, and over time, high-quality assets have been snapped up and prices have increased even for lower-quality assets as money went in search of yield. That's what's resulted in what's called cap rate compression. You get C product selling for a price that frankly is far too high for the quality of product that it is. And while there has been some economic vacancy in rental apartments, largely fueled by the moratorium on evictions and of course the loss of jobs associated with the pandemic, we're not seeing falling values in multifamily apartments, at least not on a large scale. It's just not happening. Rents are holding stable in general, and occupancies are remaining fairly high. Again, this all depends on very local market conditions. I personally would not invest in markets with shrinking populations. That was true pre-pandemic, and it's still true today. If you do choose to invest in a market like, say, New York City or Chicago, be aware that you're making a bet on market trends reversing direction from the past several years. Chicago, for example, has lost population consistently over the past 5 years for reasons that could be considered underlying and systemic. There are issues with crime, high taxes, anemic employment growth, all of which have contributed to people leaving the city in search of greater opportunity. From my perspective, and I can only speak from my own investment criteria, our criteria has hardly changed at all over the last 5 years. What has changed are the underlying market conditions in some submarkets. Some areas have become more favorable for investment and others have become less favorable. The key is to establish a disciplined approach for what meets your criteria, then and only then consider pulling the trigger on an investment. I personally like single-family homes for rentals, but I like them as a purpose-built product. So I would certainly go out, I would buy a patch of land, I would build an entire rental community and rent it out for the long term, the same way that I would go out and build a multifamily apartment complex, but it's a different product. It's a product for which there's strong demand, and the cap rate that that product is attracting in the market is generally quite good because demand for that product is extremely high. I want to thank you, Alan, for a fantastic question. For the listeners at home, definitely pay very close attention to what's happening in your local submarket. Make sure you pay attention to those three main criteria: the submarket, the people, and the specifics of the deal. You got to meet your criteria on all three fronts. Have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.